Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Mullen Automotive Stock, SoFi Technologies Stock, Palantir Technologies Stock, and NEO Stock. For Mullen Automotive, we're going to talk about and analyze an article that's titled, Dear Mullen Stock Fans, Mark Your Calendars for January 19th. So clearly there could be a huge catalyst coming up for this company. After that, we're going to discuss SoFi Technologies, along with other news updates that investors should be aware of. After that, we will analyze Palantir Technologies by going over their latest news updates as well as price targets, and then finally, we will conclude by talking about NEO Stock and what analysts and professionals deem that this company should be worth in terms of their overall share price, and if they have any catalysts coming up overall. So we're going to be doing a deep dive on all four of these companies, and if you own any of these companies, remember to go and smash that like button so I know to make more videos on these stocks. Subscribe if you are new, and without further ado, let's jump right into today's stories. Mullen Automotive is an electric vehicle manufacturer that currently trades for 28 cents per share. Some investors really like this company and some investors don't like this company, and today we have more of a bearish negative article. I myself do not own any Mullen Automotive stock, but many of my subscribers do, so I want them to be aware of a potential catalyst coming up on January 19th. Mullen Automotive, ticker symbol MULN, has been a very troubled electric vehicle startup company that is trying to execute a reverse stock split on January 19th. They have tried to do this previously to get shareholders on board with this, but it lacked quorum, meaning that their investors either didn't vote at all or many of them didn't even really care. And this means that there is a lack of understanding of the fundamentals of this company and that many investors or traders are only in this company for the short term. That means long-term investors such as myself should probably stay away from this company. But why do they want to perform a reverse stock split? Well, a reverse stock split is going to increase their share price so they will not be delisted from various indexes. For instance, they have until March 6th to get above $1, otherwise they could be delisted from an index. Mullen also says that the reverse stock split could be anywhere between a 1-for-2 split or a 1-for-25. And I personally think they will do a 1-for-25, meaning that their current share price of around 25 to 28 cents is going to make the company trade for around $5.75 per share, while their market capitalization will maintain its current market cap of $400 million. Now, overall, this can act as a temporary catalyst for the overall share price, causing investors to potentially activate a short squeeze in this company, but overall it looks like the share price of this company is headed downward, so I want to make you aware of that. Also, there's another deadline that is coming up in May, and that is going to determine whether or not Mullen will remain part of the Russell 2000 index. But if they do this reverse stock split, that's not going to be a worry, at least not for a while. They're kind of kicking the can down the road because eventually, even if their share price rises to $5.75 after the reverse stock split, it's going to fall back down to a penny stock unless they really start manufacturing vehicles at an astounding rate. Right now, the reason I am not invested into Mullen, not necessarily that it's a bad company, but it's just not aligned with my investing style. And the reason I am not bullish on this company is that they lack cash to deliver on their promises of mass producing their electric vehicles. They have a relatively weak balance sheet, they're in a substantial amount of debt, and based upon two recent acquisitions, they are stretched for cash. They recently acquired Bollinger Motors as well as Electric Last Mile Solutions, also known as ELMS, and this has put them very far back in terms of their overall liquidity on their balance sheet. Their CEO, who's actually a former music executive, not necessarily somebody that specializes in electric vehicles, makes their management pretty weak, on top of showing relatively little regard by diluting shareholders. On top of that, we have to remember that they've been showing off their Mullen 5, which is pretty impressive. However, we have had continuous promises that have yet to be fulfilled in terms of their overall production, while the CEO continues to say that production for the Mullen 5 will begin real soon, but as of right now we don't have any hard date for that. All of this adds to a pretty sketchy stock, and if you're not in this company to trade it, I would probably stay away from this company. But some investors are holding on to hope, considering that Blackrock, which is a very prestigious financial institution, continues to buy Mullen stock. Now, I've gone into detail about this in the past. They're doing this to just diversify their overall portfolio, and the risk to reward ratio is actually good for them by doing this because they're only allocating a small portion of their portfolio to do this. A good part about Mullen stock is that they recently hired very experienced personnel from both General Motors as well as Ford Motor Company. So I'm very interested to see where this company is headed in the future, but until this company proves themselves, I am not personally going to invest into this company. So what's next for Mullen stock? Well, the author highlights that a plethora of various electric vehicle companies, including BYD, NIO, Tesla, and even legacy car makers are down right now, so it looks like Mullen will also fall. However, the current catalyst that we should be looking at right now is their potential reverse stock split on January 19th, which again will increase the share price temporarily just for it to fall back down later unless it causes a huge short squeeze, thus catapulting the share price up to over $6 per share. And if you're going to jump from around 28 cents to substantially higher than that through a reverse stock split, this could give the illusion that the company has actually surged when it hasn't. That could excite investors and actually inflate the overall share price. But if you are a long-term investor and you believe in this company for the long term, it's probably wiser to wait for this company to prove themselves before you invest into this company, and that's exactly what I'm doing. The next stock we're going to talk about is SoFi Technologies and why it's an attractive buying opportunity right now. However, Zacks.com says something different. SoFi Technologies is a fintech company or a financial technology company that offers an all-in-one inclusive digital app to their consumers, which gives them anything they could possibly get at a regular bank. Essentially, SoFi operates as a digital bank, so you don't have to enter a brick and mortar store. It's very convenient because you can do it all on your phone or online. Right now, SoFi Technologies, ticker symbol SOFI, is trading for just $4.49, while investors believe this company could surge up to $10 over the next 12 months. SoFi has been trending on Zacks.com, but many investors are still wondering where the stock price is headed in the near term. I personally don't care where it's headed in the near term. I am a long-term investor because I think in the next 5 to 10 years, the stock price is going to be substantially higher than it is right now, and that's the bet I am making. However, if you are a near-term investor, then you really need to listen up to determine if this is a buy and hold company, which this particular author agrees with. He says ultimately, this is going to be a buy and hold company overall. So let's see why he thinks that. Well, first let's look at their overall earnings per share, also known as their EPS. For the next fiscal year, the consensus earnings estimate is a loss of 23 cents per share, and that indicates a positive increase of around 46.1% for SoFi Technologies, which is very exciting. This means that they are slowly reaching profitability, and right now they're currently projected to reach profitability at around 2024, most likely toward the end of the year. Even with that being said, Zacks actually thinks that this company should just be a hold rating. So investors, if you are already invested into it, as long as you are not overexposed, because I myself have less than a 5% allocation to this company, you might as well just hold this company until they become profitable, and that's when the share price is actually going to start increasing. But in the meantime, considering macroeconomic factors, the company could lower in their overall share price. While earnings growth is arguably the best and the most superior financial metric to determine the financial health of a company, what about their revenue growth? Well, SoFi Technologies has had amazing revenue growth to where their current sales estimates for the current quarter come in at around $424.17 million, which would equate to a growth rate of over 48.5%. On top of that, for the next fiscal years, we could see the company bringing in $1.53 billion in total revenue, and the year after that, they could bring in $2.06 billion, which is absolutely insane. This would indicate a 55.8% growth rate and a 34.4% growth rate, respectively. As long as this company continues to grow over a 30% CAGR, the company is most likely going to attain a profitability at the end of 2024, thus increasing their overall share price. So if you're willing to hold this company right now until 2024 or 2025, despite what the near-term news says about this company, because this company does have the potential to fall from its current price to around $3.26, we could see this company surge in the later years. So it really just depends on your own risk tolerance and your overall investing strategy for this company. Up next, we have Palantir Technologies, which is in a similar boat, and their ticker symbol is PLTR. And this is a big data and analytics company that serves both commercial enterprises as well well as government clients. Right now, they trade at just $6.25, while various investors believe the company could surge over the next 12 months to $9.15. Palantir Technologies is one of the most searched stocks right now, so many people are interested to find out whether or not they should buy this company or not, and it honestly just depends on your overall strategy. For instance, Palantir Technologies is expected to post earnings of a 3-cent per share on the positive side, and this would indicate a 50% or a greater than 50% increase from a year ago regarding the same quarter. So this is positive. On top of that, for the current fiscal year, the consensus estimates that they're going to bring in 4 cents for their EPS, which is actually a change on the negative side of a loss of close to 70%. So that's not very positive. However, for the year of 2023, regarding their next fiscal year, they're supposed to bring in, according to estimates, around a 15% EPS, which would mean the company grew their earnings per share by 273.3%, which is absolutely extraordinary. Similarly, this is why Zacks gives Palantir Technologies a hold rating as well, meaning that current investors should just hold the company as long as they are not overexposed from now until the company becomes profitable toward the end of 2024. They're in a similar boat than SoFi Technologies. However, I think SoFi Technologies is trading at a lower premium than Palantir Technologies, thus making it a slightly better growth stock. However, long-term projections are going to determine which of these companies are better, considering that they are very different. But what about their overall revenues? Well, Palantir Technologies currently has forecasts for the current quarter that they're going to bring in $505.95 million, which would equate to a change of 16.9%. And this is actually a huge gut punch because they were supposed to bring in originally a 30% growth rate, then a 25% growth rate, and then that was lowered to a 22%, which is lowered to now a 16.9%, which is not giving investors a lot of confidence in this company. For the next 2 fiscal years, the company is supposed to bring in $1.9 billion, and then the year after, they're supposed to bring in $2.3 billion, which would equate to a 23.4% and a 21% growth rate in terms of their overall revenues. And although this is not as high as a 30% CAGR like SoFi Technologies is doing, at least the company is growing at a respectful rate, but in the meantime, the company is overpriced and trading at a premium according to current metrics and forecasts. So if you are a long-term investor, then feel free to hold the company if you are not already overexposed more than a 5% allocation. If you are exposed more than a 5% allocation, you could liquidate some of the company's shares and invest into a much safer investment such as VTI or VOO. Up next and lastly, we're going to talk about NIO stock, which is very interesting because a plethora of various electric vehicle companies are falling right now, and NIO is a Chinese electric vehicle company. The main reason why EV stocks, technology stocks, and the majority of the stock market is falling right now is due to either supply chain shortages, sky-high inflation, and rising interest rates. However, this has particularly hit hard electric vehicles, and that's why investors, at least smart investors in my opinion, are taking advantage of this dip by buying into electric vehicles right now, because as the electric vehicle companies are being beat down in their share price, this offers a better investing opportunity, and we're really seeing this take place in companies like NIO as well as Tesla. Right now, I still think Tesla is the clear market leader, and I don't think anyone's actually going to catch Tesla, at least not in the next decade. I think the most prominent company that could most likely do this would be BYD, which is another electric vehicle manufacturer over in China. But in this video, I want to focus on NIO, because NIO is trying to compete in this space against Tesla, and many investors believe this company could surge. Right now, the NIO stock is just trading at $9.74 per share, but investors believe it could surge up to $20 over the next year. So what does this mean for us? Well, it means that this could be a good buying opportunity, and the two reasons I like NIO is, one, is that they are one of the largest players in the capital EV market of the world, which is China, and they mainly focus on the premium EV market. Tesla is clearly a much larger EV player over in China, but NIO has a very strong foothold in the premium market. So clearly they have an advantage over Tesla, on top of having a very impressive battery as a service program. On top of that, by June of 2023, NIO expects to have a total of 8 models on sale over in China. So clearly NIO has the home advantage by selling to the EV capital of the world. Another reason why I like this company is that they are already expanding internationally because they have entered Europe and their plans are just beginning. On top of that, they are selling premium vehicles for a pretty cheap price. What do I mean by this? NIO is already working on mass marketing and producing vehicles that are going to be priced between $25,000 $28,700 to $43,000. And these vehicles should be ready for delivery in China during the second half of 2024. This is extraordinarily cheap for electric vehicles, meaning that clearly NIO is going to be a price leader in this particular regard, which is going to drive up demand substantially. The reason why they can have such low EV prices, particularly just a $28,000 electric vehicle, is that NIO plans to manufacture their batteries and semiconductor chips in-house, which is going to save them a lot of money. Thus, instead of putting those costs to the consumer, NIO can literally use this, because they're making it in-house, to produce cheaper vehicles on average, while also boosting its overall gross margins. So this is a very, very unique thing that NIO is doing compared to their competition over in China. Now, what about the company's overall financial health? NIO has a load of cash on hand, and many professionals, as well as their CEO, believes the company could break even in terms of profitability by 2024. So this is another company that you could invest into right now that will be profitable in 2024, and then once they become profitable, that's when the share price is going to start skyrocketing. Right now, NIO has a very healthy balance sheet because they have around $2.5 billion worth of cash or cash equivalents on hand as of September 30th of 2022, and if we include short-term investments and restricted cash, its liquidity is currently around $7 billion. So let's put it into perspective. Literally, if NIO stopped selling electric vehicles right now, they could survive for quite a while, but they're not doing that. They're actually using this cash very wisely, investing into themselves, manufacturing their batteries and semiconductors in-house, making cheaper electric vehicles, and this is going to push them toward profitability much quicker. Now, I do want to add that this is a Chinese stock, which means you are taking on geopolitical risk. If anything were to happen between the West and the East, particularly the United States or China, you're going to see this company absolutely drop in their overall share price. So you are taking on inherent risk by investing into a foreign company. But if you are a fan of electric vehicles, NIO is one of the best on the market right now, according to professionals. On top of that, the company is growing their revenues extremely rapidly to where they brought in nearly $6 billion of revenue in the past 12 months, while the current company is worth around $18 billion. So they are trading at around a 3 PS ratio, or a 3 times price to sales multiple, which beats the majority of electric vehicles on the stock market right now, meaning that this company is a great buying opportunity. And as the overall share price goes even lower, it becomes an even better buying opportunity for you to enter into this company. But what do professionals have to say about this stock and various price targets? Well, a Morgan Stanley analyst recently says that this company is a buying opportunity, and he gives it a price target of $16.10. He's very impressed with the overall delivery numbers of this company because they are set to deliver between 38,500 and 39,500 vehicles over the next quarter, which is actually a decrease from their original forecast of 43,000 to 48,000 vehicles, but that really doesn't matter because they're still bringing in strong numbers. But overall, what do analysts actually say for this company? Well, the overall rating from Zacks is actually to hold this company, but if we look at other analysts and websites, the current share price trades for around $9, with 9 analysts saying to buy the company, 4 saying to hold the company, and none of them that were surveyed saying to sell the company. The average price target is around $16.29, which would mean investors could make around a 62.98% upside in their overall investment, which is astounding. On average, the market would return to you anywhere between 8 to 10% over that same time period. So NIO is going to allow you to make 6-fold more money than investing into the broader stock market, at least in the short term. The lowest stock price target for this company comes in at $11.27, which means even the lowest stock price target has upside, while the highest price target comes in as high as $28. So, in all, the electric vehicle market looks primed for future growth. Feel free to look into other electric vehicle companies. I just posted a video on the top 3 electric vehicle companies in the United States that I personally like besides Tesla, so feel free to go check out that video as well. In the end, if you want to see more videos on Mullen Automotive, SoFi Technologies, Palantir Technologies, and NIO stock, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and I will see you in the next YT video.